Say hi, everyone. It's the fourth. It's our fourth show, right? Yeah. Fourth
Yeah, man.
Whiskey Wicks. Uh, Appreciate you all being here. So, this week is going to be a little bit different than the last three, I guess, in the aspect that today we're going to talk to actual. The panel today is actual professional traders, not us retail. Before we start, just to clarify this from the beginning, none of this financial advice. This is entertainment. Just listen to us chat. That's what this is about. So, I think the main factor for I'm personally pretty excited about this panel just because it's very interesting to see how both me, a retail trader, and the panel who are institutional traders both think we're trading, but it's very different from both angles, and that I find kind of fascinating. Uh, so yeah, let's just get into it. I'll let the panel introduce themselves first, and we can get into it. So, Josh, if you want to start.
Sure, yeah. My name's Josh Green. So I'm a partner at a trading firm called Orthogonal Trading. We're cryptocurrency only. We do a few different strategies, both with our capital and external capital, focused mainly on derivatives, some systematic trend following, a bunch of different market neutral arb strategies, and a lot of options trading. Before that, I was at another cryptocurrency hedge fund trading for 2 years down here in Sydney called DACM, and before that, I spent several years as a macro prop trader at a hedge fund inside the bank, so effectively like an internal prop desk down here in Sydney, trading FX rates, vol, and linear products, pretty much everything. That's the 2-second background.
That's it. No, Gary.
Yeah, my name's Gary Norden. I'm a partner in a hedge fund. We don't trade crypto as such. We design trades with zero correlation to equities, mainly derivative trading again. The past sort of 15 years in Australia, I've traded and run a consultancy firm to other hedge funds to design trades. Previous to that, I'm from London. I was a derivative trader for a number of the large investment banks, convertible bonds, options. And I also traded on the futures exchange. You can see some jackets behind me. I was an options market maker for a number of years in the London futures exchange, and also head of interest rate options for NatWest.
Thanks for that, Gary. And our very own Grant.
Yeah, man.
Quick intro. We know you, but just a quick intro.
Okay. I guess been trading now for almost 20 years, personally, professionally. Biggest book ever was when I was at an insurance company. We had over $16 billion in management at one point. I've been trading crypto really since 2016, and now I'm the CEO of Mind Digital, Australia's latest, best, and up-and-coming currency exchange, cryptocurrency exchange. Also, we do currency as well. If you need FXs done, come to Mind Digital.
Yeah. We'll give you the best rates as well.
Yeah.
Okay, so I guess let's just to get into it. Let me ask the questions first, I guess. Okay, let me just to break it down to very simple terms. At the end of the day, trading is in essence something that is as a concept is very simple. You're buying low, selling high. That's essentially what it isn't that easy in practice, obviously, but that's in essence what it should be. Now, I personally have been trading for the last 7 years, and I do not in any way classify myself as a trader, although people tell me I probably am because I do use that income to supplement my income. I rely on that income somewhat. So somehow I may fit into that, but I personally really don't think I am. But what I want to know is how you guys feel from and from what you see on Twitter, Facebook, other people talking about traders, retail traders in general. How do you see institutional trading being different than that? Or what are the main things you see that are very, very different opposed to the other? Whoever wants to start can start. I'm going to ask all three of you are going to have to answer it.
Gary, you want to kick it off, mate?
Yeah, all right then. Well, look, I've been playing golf for 30 years and I'm definitely not a golfer.
Yeah.
The reality is that what I see on Twitter, social media, for 95% plus of the time doesn't resemble anything that I consider to be trading. People just picking levels, drawing charts, lines on charts, that kind of thing is very retail focused. To the retail trader, that looks like what trading is. in my time, not only investment banks, but, talking to hedge funds, if people come in and are trading based off the break of some line or some chart or something, most of the time, almost all the time, really, they'll be laughed at. So what I see out there on Twitter and the retail industry is very, very different. The number of inputs we have into what, how we consider to trade, how we go about deciding on trades and how we allocate to that is completely different. So in the same way that the way that I practice my golf, the way that I play my golf is so different to the way that Rory McIlroy will play golf, for example. In theory, we're both playing golf. In reality, there's a massive difference. And I use that a lot, that analogy between professional and amateur sportsmen. There's a lot of, we all play a bit of amateur sport, but there's a massive difference between what we do and what the pros do. It's the same in trading. There's a lot of people that call themselves traders, but they're just like me on the golf course, really. And really, they shouldn't be doing it to try and make a living. That's what I see, because it's just, unfortunately, it's very different from what we're doing.
Okay. Yeah. Josh?
I think, I agree.
You've switched over from the traditional world into our little world of crypto. So you must be having a laugh at how different things are and how...
Yeah, it's interesting trading crypto versus a normal market and the participants you trade against and all of that stuff. I think crypto generally is set up. It's a less complicated market than a traditional market because there's less inputs. It's less sophisticated. There's less things to look at. So, trading, if I'm trading a macro market, it can be whatever. Say, trading interest rates. You've got, a lot of curves to look at, different, carry, different factors, funding, macro markets, central bank policy. The list just goes on and on and on. If you're trading crypto, there's more inputs than I think people consider, but there's a lot less inputs than in a normal market. And obviously, the participants are a lot more retail driven. So, it's probably, in that sense, it suits them more. So, put it this way, so if I was trading a macro market, say, like charts, for example, or technical analysis might be, 15% or 10% of my process. In crypto, it's higher purely it still would be under 50, but it's higher managed because there's, a lot more self-fulfilling, it's a lot more of a self-fulfilling nature of it. And I would say I'm not necessarily always, I might be using charts to say, okay, well, I think everyone's probably going to buy it here, so I might sell some there. I'm not necessarily just doing what the classic charts suggest. But I think so. Aside from just the lack of rigor, rigor around what you're looking for and how you're looking at it. Are you testing these things? Are you testing a hypothesis? If this correlation is this now, what has it been in the past, and where do we sit, and why will it change, and going to change, or is it a structural or cyclical thing, et cetera, versus just logging in and having to swing around and see what happens. It's a different thing, really.
Yeah. Grant, you've had an even bigger leap of leaving that world and entering ours. What do you think? What do you think from what you're seeing, or what you've seen over the years?
So the other big difference is when you are an institutional trader, you trade to different benchmarks. So you don't necessarily always trading just long short. It could be, like, a good example was, at the time when I was at IAG, for regulatory reasons, we had to get our Aussie equity exposure lower. So what I was basically told was, you've got to get it lower. Now, I could go out and sell SPY futures, and that would get it lower. And that's a linear way to do it. It's just like going short the market. But then essentially we did a bit of analysis, and you find out, actually, if I go do this type of call spread versus, and these other option structures, all of a sudden I can get the equity exposure down. But if the market does nothing, if the market goes up by 3%, I might make 3%. If the market goes down by 3%, I only lose 1%. So if you're just long short, you always just lose whatever the market moves. Whereas this way, I was, as I said, trading to a different benchmark, which allowed me to do this trade. Now, the market actually didn't go the way I thought it would, but from a career point of view, I was still, that was still a good trade because it achieved what was needed given the prices that we could have achieved it for, I achieved it better. So oftentimes in institutional trading sense, there's not so much have to be a focus on being right or wrong, i.e. you're either long or you're short. It's more got to do with, a lot of these other, nuances to it where you could be adding value to your firm, but you don't necessarily get your market call right, which takes a lot of pressure off you. It's just far easier because I have done the opposite of that. I then worked as a prop trader for 6 years and where I only got paid on the money I made. And the pressure of that is very different compared to an insto guy where normally, P&L is obviously important and things like that, but there are other factors that can dictate the success of your career.
I would add that, having only ever traded prop either with other people's money or my own money, I personally find it easier to trade PA than I do other people's money, mainly because when it's PA, it's just your own, it's just your own stuff you got to look after and you're not really responsible to anyone else. But when you introduce a fiduciary duty, as an institutional trader, that's, there's a whole different kettle of fish in regards to risk management. If it's a PA, I find you can just go, all right, I'll be 100x long and if I get the credit, so be it. But if you're an institutional trader, you can't afford to have more than a 3% drawdown and you still expect to put up the same numbers. You're obviously not going to be taking the same approach, are you? So I think, the risk management side, the views are the views, that's fine, whatever. But, on that risk management side and portfolio construction side, I think that's a really big difference between, a retail personal approach and a professional approach.
And the other thing is, I don't think you can underestimate, mate, is the amount of the investment into resources to be a trader. Like, I'm not talking about the time and the personal side because that's the biggest investment, but the actual tools is oftentimes for a retail trader either too expensive or they don't have the technical capability, to, use them themselves. Like, i.e., I could come and give you the best trading front end, but, you've got to it's got to be a fixed connection. Well, as the amateur guy you might be able to write a bot to work on Binance, but for you to write a fixed connection to a new order management system, you need an expert to do that. You could self-teach yourself it, but it's very difficult. But that's the other big difference is institutional guys, you just have so much more resources at your capability. It's not just money or capital. It's all the other things, it's support staff, it's technology, it's information, it's all that.
And time.
Yeah, it is one of the things I noticed is that, I was just looking into it a bit just before we got onto this chat. And it's just that, like you said, Grant, there's more than just, even what Greenie said earlier, that it makes up, technical analysis is a certain part of my thought process. It's not, I do not just purely base it on where something is. That's just part of it. And I think Gary said that to me yesterday, and it's people trying to make it simple. I guess it's just there's a lot of incentive for people to spread misconception about trading, to tell you that trading is easy. Just like anything else, trading, as a trader, that's your profession. The three of you have been doing it for a very long time. It's a profession. It's something that you're either good at, you're not. It's a skill. You need to have that. And there's more to it than just, if anybody could draw a line and become rich, who wouldn't want to be? But that's the message that's taught to us, is that all you have to do is draw this line, you follow the line, you can turn 10 grand to $1 million. And anybody can do it. I know, Gary, you have interesting thoughts on technical analysis per se. Do you want to give me your share in that?
Yeah, very interesting thoughts, I think. Now, look, from my perspective, and I spent a lot of time looking into it when I researched my first book, which I'm about to re-release and give it away actually for free. From my perspective, I could, in all the banks and everywhere I work, no one ever used it. No trader I ever worked with used charts. It was only used by the sell side. I think in recent years there are some, particularly here in Australia, some bank traders that will use it. But what I try to do is investigate. When I spent 2 years researching it, investigate the assumptions behind it, which I think are completely flawed. The construction of charts themselves, which I think are completely flawed, And then I contacted universities and institutions around the world, and it turns out there's been lots and lots of studies. Everything you could have looked at in technical analysis has been studied, and the results are shocking, but not shocking to me. But the reality is that there's absolutely no basis for the, whether it's moving averages, candlesticks, chart patterns. They've all been tested and shown to be, completely unreliable. And the reality is that the vast majority of people that use them will lose. But the industry knows that, because any broker will tell you that, the majority of people on his platform are using charts and technical analysis, and the majority of this is retail traders, and the majority of them lose. That's just widely known. And I think, just to come back to something that both Grant and Josh were saying before, I think when you work in the industry on the institutional side, or whether it's hedge funds like now, there's a couple of things that I think in the retail industry are perhaps complete misdirection. And one of them is that this is a business of prediction. So retail traders are told that trading is all about prediction. You've got to predict where something's going. And that's not actually what trading is about, particularly at the higher levels. There's a lot more to it than that. Josh talked about risk analysis, and that's very important. Do you want to make money if it means you're taking on huge amounts of risk? That's a different question to just picking direction. So for us, we have to, look at all those things. So if you tell people this is an industry of you've got to pick the right direction, that's going to send more people to technical analysis, even though it's not very good at doing that. But the reality is, to try and pick direction day in, day out, week in, week out for 20 years is a ridiculously difficult thing. So the business isn't just about that. The business is a lot more than that. And the second thing, I think, the longer you're in this industry, the more you like and are comfortable being contrarian. Whereas technical analysis is about trend following, right? You want to go with the trend and go with the herd. And most people are more comfortable buying something when everybody else is buying it. Whereas to me, that's one of the worst trades I could have, right? If I'm long and everybody else is long, I'm petrified of that trade, right? Because that's the sort of trade that can only go horrible. So, the view from our side and from retail traders is, there's, when everybody loses, they will go, well, it doesn't matter because everybody else lost as well. There's some sort of comfort in losing with everybody else. I don't find that comfort. I just don't like it at all. But in terms of technical analysis, yeah, I just think that for the majority of traders, and I'd say I'm about to republish the book for free and give it away because the evidence is clear. I mean, the evidence is absolutely clear on it. I don't, I don't even see, but the technical analysis industry is just very good at promoting itself. But, I can raise a number of arguments as to why it's just illogical. I could talk for hours on it. Sorry, I better shut up.
I think I'll give. I won't go against Gary and go a full rebuttal. I think the one saving grace element, or not one saving grace, but definitely, I think a more constructive element of it is it comes back to the point that Gary almost said, but he didn't quite. Well, he did say that trading's not about prediction, and that's 100% right. At the best level of trading, it is got to do with something about your personality, understanding your personality, and understanding you and how you handle stressful situations. I've seen time and time again on trading floors the guys who can predict the price and lost the most money in the trade because they thought it was going up, so they bought it. It went down, it went back up, so they bought more. And then it went down, and then, it sort of maybe went sideways, and all of a sudden it just went down, and they're stopped out. But 20 minutes later, it's hit their price target. But that's the thing, is trading is about that psychological management more than half the time than getting your calls right. If you do the time and you spend the time in the market and trading and reading and analysing yourself, in about 5 years' time, you can probably have a pretty good feel for the market, especially if you watch it closely. You do, like myself, you do scalping. But, longer term though, the thing that's going to determine your success is do you stick to your plan? Do you implement it? And, what's that look like is way more important.
Yeah, I'd have to agree with that.
I would add I would just add, can you guys hear me? Just quickly.
Yeah, it's a bit buzzy, mate. I can hear you.
Yeah, I think it's my computer, I think, doing the buzzing. I'll stay on mute when I'm not talking. Two things. One is, I always think it's, more important than your trade ideas are your position sizing. And to a certain extent, your views are almost irrelevant. It's really your position sizing that matters. For example, I mean, you can have, win 52% of days in a year and have a really good year, and you could win 80% of days and have a terrible year. And as Grant alluded to, staying in a position and appropriately being able to add to that position, when you should be adding to it, and taking it off when you should be taking it off, is pretty key. And from just back on the technical analysis point, I think it at least partially depends on the product you're trading as well, right? If I'm, what's an example? If I'm crypto and I'm, trading some crypto vol, I'm not looking at the vol curve and saying, oh, look, the vol curve, steepened through a resistance level build on the back end and short the front end. I don't really care about any of that. Trading a completely separate market. I might look at it and say, oh, there's a consolidation pattern here. I think there'll be a lot of, FOMO and a bunch of stops that go off afterwards. So maybe this is a strike. I want to be long or short, or maybe I think vols will do this if they get through, and they'll do the other thing if they stay below, etc., etc. So I could be in a position with, say, a large topside call position, and everyone starts buying the breakout, and Michael suddenly got in the money, and I'm trading at delta neutral, so all of a sudden smashing out a bunch of spot. And everyone's, oh, well, why are there lots of sellers? It's got nothing to do with the price necessarily. So I think there are a lot of other dynamics that you've got to be aware of when you look at the markets. It's not a bunch of people trading spot with a spot view.
Yep. Okay, that's fair. So I mean, so Gary, if not TA, how do you? I mean, you're obviously going to tell me how you exactly trade, but well, what are the main things you use to make, like, how do you make a decision on a trade? How do you, roughly at least, or as a framework, what do you look at? What do you go by? And what do you mostly trade? Like, well, what do you guys trade? Equities?
So for us, at our fund, we design trades with zero correlation to equities. So and we design them in a bunch of different contracts. So we use some volatility products like VIX, VXX. We look at ES, mainly options. And for us, it's a lot of it is volatility trading and using the different aspects of options to create these types of trades. And as I said before, but if I'm doing directional style trading, which I don't do much of anymore, it's about taking in a wide variety of information, not only how that contract's trading, but how other contracts are trading, using correlations, and, again, try to work out certain risks. And to me, like a chart or the history of a contract, there's nothing in there about what will happen in the future. Nothing in there about what will happen in the future. Just because something is trending high doesn't mean it goes higher. All the chart and the history tells you is how people are positioned. And market positioning, I think, is more important. And in fact, I was listening to a podcast only a couple of weeks ago, and it was an interview with an ex-Goldman's FX trader, and they asked him, what's the most important input into your trading? And he said the similar market positioning. I think market positioning is very important. If how people are positioned, if they're very long and then working out what can happen. Lots of people long of this market. What could happen if they're wrong? What could happen if they're right? And that's the kind of situation, rather than just say lots of people are long, it's going up, I follow the trend. That's just very simplistic and wouldn't go with it. But like I say, I think the more, even when I started in a bank, the first thing I'm doing is putting on long positions, short positions, and just trading market direction. But the longer you're in this industry, I think the more you look for, if you want longevity, is to find ways of trading which are not just about continually trying to pick direction, because it's such a difficult thing. So trading volatility, using the skew of options, and I'm sure Josh does a lot of this as well, looking at option skews, looking at volatility, looking at all the different other things that you can do, which are quite cool, quite smart, offer good risk reward, the different option strategies as well. And they can all, the more of these sorts of ideas and knowledge that you learn, the more other ways of trading that you have. And I think that to me is what I love about trading, is just to, have a bunch of different things and try to work out which one's right. And sometimes you'll go through a whole bunch of different trades. You've got an idea, but you just can't find one that offers you the right risk reward. You just have to leave it alone. But I think that just saying it's going up and it's going down, that's the simplicity that, it would be lovely if we could all do that, but it's like not even 1% of people are going to have a career doing that.
I think that's something that's a very important thing. It took me a long time to actually learn, was when you don't jump into it just because you need to be in the trade, rather know when you're entering, when you're leaving, be aware of that. Surprisingly, It took me about 3 years of personal trading to actually figure out that was that important, that there's no such thing as I missed it. You'll catch the next one. Just know when you're getting in and when you're getting out. That, I guess that's another thing. I mean, I keep saying, so I personally, as soon as I start tweaking up the leverage, to me, I feel like I'm gambling. And I openly admit that what I'm doing is satisfying my need to gamble. That's, especially in crypto, when you start going 25x and anything higher than that. I mean, you are gambling. I see the cheeky smile on Greeny's face over there.
One of the questions we always get asked without fail is how much leverage do you guys use? And I mean, our leverage is a bit of a misnomer because A, we're active in the borrow lending market, predominantly from the borrow side, and B, when you're on options positions, leverage is a bit of a joke because if we've got 1,000 BTC, we can easily be long, 50,000 worth of BTC worth of calls. But I mean, our exposure is our leverage is nothing like what's implied. But I mean, if we're trading on BitMEX or somewhere, for example, like that, we would never be using more than about 2 or 3x.
2 or 3x, yeah.
And that's basically. I mean, sometimes less.
No, yeah, I mean,
yeah.
No, go ahead, Gary.
Absolutely. Like just to echo Josh. Yeah, I mean, very few people want to or need to trade on 25 plus leverage. There might be legitimately 2 trades a year where you really want to back up the bus, and that would be handy for. But again, the funny part is when that actually happens, for a lot of traders, that's going to be the most stressful time. Like last night, for example, you're sitting there, Bitcoin falls out of bed, goes from 10,150 to depending on which exchange you're on, call it 9,400 broadly. Like at that point, well, where'd you go? If you leveraged up, what price you got in at really then hurts you and really affects it, right? Because if you put on, when it cracked through 10,000, it did the first bar pretty much like to 9,650, 9,600. If you've then gone and stacked on, well, look, there's a big fall, it's a great idea to buy it. If you put on 100 times leverage, you're not even going to be able to, let the trade breathe. Because pretty much last night it went straight back up, like to, maybe $50, and then just whipped straight back down 250. And then, you're stuck then in a massive position that's offside. And at that point, you're not making any rational choices.
I think, if you're trading any asset, if you don't have a good idea of the distribution or the probabilistic distribution of that asset at any moment in time on your relevant time horizon, you're really not doing it right. Like, you should be aware that BTC trades with a vol of X, which means it can move Y, and historically over this time period and this time frame it does Z, and pick another letter. And I think it's going here, that's cool. So any of these outcomes over the next 24 hours on my 1 hour chart are like a reasonable probability, and I should be willing to either buy more or, get rid of it. But it shouldn't be the end of the world. Like, everyone should know that BTC can fall 20% in 5 minutes, like on MEX, like it's just a thing.
No, yeah, it definitely does do that. I think another thing people fall down the hole of is, mathematically, if you calculate it, if you're consistent and can make yourself X% a day, it doesn't really take you much to actually accumulate a certain amount. But if you're sitting there with 25x trying to trade a position size much larger than the amount of cash you've ever seen, and you're expecting that would happen overnight, you might get lucky once, twice. But the majority of the time, that's not going to happen. Again, especially not on BitMEX, you'll get wicked up. 100x you will get wicked out. Not even a bar. It'll just be wicked.
Yeah.
I mean, I like to think like trading is, like, at least for me, a bit. You're in a bit of a state of perpetual drawdown, really, because you're either about to have an emotional or P&L drawdown, or you're already in one. So it's like just the way it is.
Okay, let's leave technicals for. I mean, fundamental analysis. We can't really argue whether that works or not. It's just fundamentals of something and how does it function, blah, blah, blah. So, I'm just looking at the S&P. Why are we green? And it's been closing green for the past few days, despite America burning down. We say Bitcoin is manipulated, but you insto guys, how manipulated is your market?
Well,
how propped up is it? It doesn't make sense.
Trust me, Omar, we have a call every morning.
It doesn't make sense to me.
300,000 on a Zoom call. We all have a call. We decide where we're going to.
There's riots.
The last time there was riots in the US, right? I think SPU rallied like 15%. So, like, there's some historical precedent that does quite well in a rally for whatever reason. Maybe monetary policy expectations. Who really knows? But you've got other things like dollars weak. The whole world's short, etc., etc. Hong Kong didn't blow up. China intervened, etc., etc. It floats up because everyone's short, and risk is there's lots of liquidity.
Isn't dollar weak bad for the US?
Nah, Trump wants it.
It's good for risk assets typically.
Yeah. Okay.
Sorry, Gary. Gary, do you want to opine?
No, the S&P right now, the last few weeks has been really interesting. There are big shorts. So as of about 2 weeks ago, the shorts across the US indices, NASDAQ, Russell, S&P, and Dow Jones were very large, the largest we've seen for a long time. And that always worries me. Again, market positioning. The vast majority of people who trade and invest in equities only do it from the long side. So short traders always know they're going against the wave. And when there's a massive short position, I always do get a bit worried. And there's been this huge short position, and I'm not quite sure how much longer the shorts have before they get really squeezed. But I always get worried when there's a massive short position in equities like that. And people that were short Tesla last year will figured that out as well, right? It's again, if you're short with loads of people short, it's also not a great position in something. You want to really, in a short equity position, you need to be making money pretty quickly. If you're not making money quickly on a short equity position, it probably isn't going to come. And right now, the shorts aren't out, but I think they're very close to getting squeezed. But yeah, look, in terms of the value investors of, Buffett's and that has said he can't find anything to buy. Charlie Munger says I can't find anything to buy. Stanley Druckenmiller says there's nothing to buy. A lot of those guys, and I think the Fed and their actions and they're pumping money, and they're buying junk bonds now, for crying out loud. The Fed now hold, junk bonds, JNK ETF, HYG ETF in their portfolio. When the Fed start buying companies which are going under, effectively, you've got to wonder whether this is really still a free market capitalism. And I was going to say, if we mention this, that this is probably good for your industry.
You should come to Bitcoin, mate.
Well, I think people are sort of saying it, going, this is just not a real market. Why should the Fed be banning out the real crap of junk bonds? And I think it's a fair point. That's not the whole point of this type of a market system, is that resources go away from the weak and to the strong. But if we're going to start supporting the weak as well, then it's a different scenario. So I actually think, that going forward for your industry, it's actually quite good, because I think there's a lot of traders out there looking at equities going, this is just baffling to them. So your market's actually looking a lot more cleaner.
You got to remember is 30 years ago, GDP contributions were more scattered, more decentralized for a way that our Bitcoiners will understand it. But essentially, what's happened in that period since is the majority of US wealth, GDP, et cetera, comes out of two coasts, and the middle has essentially fallen off the radar. And from a point of view that it affects earnings, that someone burns down Minneapolis, well, the S&P 500, if you did some type of analysis where you looked at the sensitivity of the S&P 500 to economic conditions in Minneapolis, you'd probably find there is no connection. And so this is a really interesting thing we've seen happen, is that the the stock market, which is about financial assets and where is it going to get those cash flows from and growth from, is divorced from the most part of America now, and that's an interesting thing.
I think it's a good point, Grant. I mean, if you look at this rally in equities was started essentially by 5 or 6 tech stocks. You know, the Nasdaq is right close,
exactly.
right? And
Exactly.
as long as people are tweeting about the riots in Minneapolis, it's bullish, right? As long as they're putting Facebook posts on the riots in the US, it's bullish. And as long as they're scared to go to the shops and sit at home buying on Amazon Prime, it's bullish because that's effectively what, as Grant says, that's what the economy is now. So it's a different world. And I think that's just the world that the people like the Buffetts and are struggling. I mean, he's underperformed for the last decade. I think it's a struggle now to that old view of find these companies and, you know, invest in what looks like a good company. These people can't find it. It's different now. Yeah, it's a different world. Josh, you've got something to say on that, I'm sure.
No, I mean, I think that the market's been driven higher by like those, you know, big 5 stocks, and, you know, the virus and et cetera, has actually been quite good for them, really. And they're almost like value stocks in a sense now. Like, they hold a whole lot of cash, you know, they produce a lot of cash, they have a lot of money, they're not in any imminent chance of going bankrupt. They suck up all the passive flows, they suck up all the active flows because people have to chase them on benchmark, like rah. So, you know, it's a hard one to fight, right?
So, guys, I just have a question from someone. I lost the question. Yeah. So the question's from Scott, and he's asking, can you open more on how the equity futures positioning is framed if all futures traded are zero sum? How do we define positioning by segment in the futures? I don't know what he's trying to say, by the way. I'm just.
Well, Scotty, you know the answer to that, mate, and that's our very kind friends of the CME ask you why you're trading, especially if you're trading volume, and you've got to answer them very nicely. That's one way we find out. So the CME asks you, are you a speculator or are you doing it for hedging? Then we have our friends at State Street who collect a lot of this data and then do some funky statistical work on it to sort of come up with stripping out what they think is passive hedging versus active hedging versus speculators versus structured product flow, et cetera. And you come up with a number there. Personally, I think the only good flow and positioning and equity stuff that I like is the cash to custodians. So, you know, BNY Mellon, JP Morgan, Northern Trust, State Street, most of them will release some type of information. It's very lagged. It's normally like about a 6 to 9 week lag, but they'll release that type of flows that they saw come in, and they know the purpose for those flows. Their clients, you know, get them to instruct the custodian to then carry out their wishes, obviously, so they know where that money's gone. But in the short term, you know, it's very difficult just looking at futures, you know, very raw futures data to come up with why, you know, how it helps define positioning.
I'm sure Gary would say you could probably tell as well, just from watching the market, from watching price action and watching how it trades, and, you know, how does it you know, operate, open and close, etc.
Yeah, I mean, like Grant said, the commitment of traders, you know, tells you the positions across, you know, whether they're speculators or hedgers. You can see open interest changes, and on the, you know, what happened on the day, you know, that open interest change can give you some ideas. So we know from that information that the number of shorts out there, you know, was quite large as of about 3 or 4 weeks ago. And actually, the types of traders was actually quite different. You know, there were different types of traders. So, you know, even some of the long-term technical guys, the long-term trend followers who use things like 200-day moving average, a lot of them are also included in that shorts. And I think that they're coming out this week, or about this week. Some of them are going and changing to the long side, which I think is something to watch for, because the 200-day moving average got them short at just about the wrong time. So, and again, we just want to look at the last time we saw a reasonably large net short position in these markets was at the early part of last year, 2019. And we know that 2019 was a massive rally in equities. And again, when I see, large short positions, I do get worried about the squeeze. And this year is a lot bigger than what we saw then. I suspect some of the shorts want to try and keep their short positions until November, till the election. I doubt they'll be able to. I really do. And that's just not about macro environment or anything. It's just I just don't think the market's going to allow them to do it. And I think some of them are going to get squeezed soon. And you'll know when the short squeeze is on and when they're near the end, because you'll really start to see some massive up days. But yeah, I think we're in a really interesting time. And we're at that point where a lot of people have been saying for weeks, this just doesn't seem right. And, there's this disconnect. You hear the word disconnect a lot, right? Disconnect because of the pandemic, disconnect because of the economy and the unemployment, and now disconnect because of the riots. But, as a trader, you have to trade what's in front of you. And you have to look at market positioning. You have to look at what's happening around. And you just have to work out the various risk rewards and the different, environment that you're in. And you can't just sit there and say the market's wrong. You can lose a lot of money doing that.
Druckenmiller's obviously one of the greatest traders of all time, and I'd put money on the fact that he's probably was long not far after his interview. I don't think he'd be riding it all the way up.
Somebody asked an interesting question. They're like, first let me answer Tom's question. Tom has a question. It's like, so do you guys think that stocks are actually becoming a store of value nowadays? Are they bringing future inflated earnings forward to today efficiently?
Oh, well, given which we spoke about with George and Chris Weston the other week, and I think bizarrely the three of us sort of agreed on it, of this deflationary, hole coming potentially. And in deflation, it's very simple. I want something that generates a hard asset, a hard yield, so that's, crops, livestock, et cetera, because at the end of the day, in a deflationary environment, you don't want to own financial assets per se. You want to be able to something that's actually delivering you money to be able to go spend. And if prices are going down, well, then you're relatively richer, because you've not been affected by that rate. So I think definitely that, and yeah, of course they brought future earnings forward as well in that same process. So instead of say again 20 years ago, most models would have ignored cash flows from year 10 onwards. At the moment, with a 0 to negative interest rate, there is an actual massive incentive to do that stuff right at that that level, that corner, because it's still at zero interest rates, it's still profitable to do some of those things. Whereas again, 20 years ago, when you had rates were much higher, you couldn't do those types of things.
Okay, Tom. Anything else you can type in your follow-up question if you have one. But I have a question from Rob over here, and he's okay. So from what I'm understanding from his question is that if institutional investors wanted to get into crypto, I mean, similar to what Josh did, moving into the space, what you did, would they pick a favorite, i.e., not Bitcoin? Would they choose a favorite coin? Will they seek a coin that they can manipulate? Now, I mean, I don't know what the actual answer to that would be, but I would assume that manipulation in itself is illegal, but if you're allowed to do it, then why wouldn't you do it? I mean, if it's not illegal, why wouldn't you? I mean, I think to you finance boys with deep enough pockets, it's like a playground, especially a few years ago. It's a full-on playground. You can do whatever you want, but what are your thoughts on that? I mean,
the fact there's so much leverage in the system of crypto opens it up to manipulation, because there's so many there's so many stops, you know, it's such a thin market that it doesn't take a lot to set off some chain reaction. In regards to the question, if institutional investors come in, I don't think they're coming in to try and manipulate the prices to make money. I think they come in and they buy a little bit of BTC and then they will sit on it basically. And, you know, over time, as they become more active, then, you know, we'll see how it all plays out. But I don't think they're coming in to manipulate it now. I think those firms are have been pretty burnt over the years, and they know they're probably, if they're coming in, they're going to come in because they think at some point it's going to look like a normal market. And if it looks like a normal market, you know it's going to be regulated. And you also know that if you happen to have done a lot of shady stuff in the past, like at some point, if you're regulated, it's probably going to get found out. So I tend to think they'll be a lot more vanilla. They'll pick some BTC and they'll be long it. And as then they get more comfortable, then, you know, they go trade other things. But there's no doubt that there's a lot of price manipulation that happens currently in the market. So, I mean, you just have to kind of just, you know, plan for it, I guess, and account for it.
How do you feel about what happened yesterday? What are your thoughts on that? What are your thoughts on the $1,500 candle up, the $1,500 candle down? How did you?
I'm not surprised. I'm not surprised at all by the up move. There were always going to be a lot of stops above 10K, I think. So that doesn't surprise me at all. And you know, I think BitMEX traded right to 10.5. The down move, I think, was explainable based around like the funding coming down and some of the basis between different exchanges and different derivatives versus physical stuff compressing back into like neutral levels. So, I mean, my personal view, if you would ask me last night, I would have said maybe we could flush to high nines and then keep going higher. Yeah, but am I like overly surprised that it went way lower? No, because I mean, I know, you know, the leveraged exchanges operate like leveraged exchanges, and you know, you get outsized moves. So yeah, I mean, it was pretty crazy sell off. It reminds me a bit of if you look at like a chart of BTC, it reminds me a little bit of the sell off that happened on May 17, where I mean there are some differences for sure, but it just reminds me a little bit of that, the kind of very bullish market, the big sell off, then the kind of close halfway up, and we'll see what happens. But yeah, I mean, there was obviously not much volume on MEX, and pretty much everyone who got long just got carted out, and it kind of, you know, and the market keeps chugging along, right?
Yep. Grant,
it's a risk. I mean, if you're buying a breakout, like you have to be. I mean, there is a chance that it has a big reversal.
To be honest, I was expecting a down, but not to the way it happened.
Yeah.
The only reason I was expecting it was literally because the main thing that I trade on is not fundamentals or technicals, or yeah, I could do that, but it's not how I trade. If I'm going to go into a big position, it is usually on sentiment, and my sentiment is once every single group, private group, paid group, whatever group I'm in, when they all say we're bullish, that is when I'm ready to go full short. Or when they all say, when they all agree to short, then I know it's time. And I'm willing to take that risk, and I'm happy to take that risk, because most of the time it does not fail to do the exact opposite of what the whole market seems to agree with. But it's just waiting and picking out when that peak happens, when everybody agrees. Because like yesterday, I mean, people were agreeing it's going to bounce at around 10K. Now, if you tried to short it right there and it did that wick up to 10,500, whatever it is, even from the early 9Ks, I mean, it would have wrecked you just because of that move. But yeah, it is. That's.
I mean, it was pretty equal. There were pretty equal liquidations on the move up and the move down. And you know, lo and behold, we settled exactly where we were.
It's like just flushed the market. That's what it did. Just give it a little rinse, cleaned it out. Just back.
Yeah, I mean, it's obviously there's the area around 10K for whatever reason is obviously it's an area of interest. So
it's a mental,
you know,
it's a mental thing with Bitcoin. I mean,
you know, it's 5 figures and
it's 5 figures exactly. In Bitcoin, that's what it is. It's 5 figures. We're finally 10 grand. Not that 9,900 makes a difference, but I mean, yeah, I think that's.
I mean, I think that the sentiment thing is like it's not necessarily clear as super clear to me, because yes, most people don't make money, and yes, typically that means that as a result, when a lot of people agree, it's generally a fade. But you also, to get a big trend, you need people to agree, and people to get involved, right? So I don't think it necessarily is like a situation where, oh, everyone's bullish, it's a sell. Like, yeah, everyone's bullish, that it might be a sell like 30% higher. I think it's like, it's looking at it in a vacuum is it can be hard to do, I think, for me at least. I look at what is everything else doing.
It is definitely something very difficult to, and something I've asked Grant to figure out how we're gonna create what are we gonna call it, the Twitter indicator.
Yeah.
See how many bullish tweets.
But as I think, you can't always tell on Twitter, right? Like, I can post a chart being like, hey, look how bullish it is, and then I can be sitting at my computer selling it, or vice versa. So, you could post a chart.
Who would do that, Josh? Who would do that? Never imagined that would ever happen.
Well, and you could post a chart that says, it's bullish, and be bullish, but then 5 minutes later change your mind and be selling it, right?
And who does that as well? I've never seen that before.
Exactly. Like you say, it's hard to know. I think that there are some good people on Twitter for sure, and like some of the traders that I know on Twitter in the crypto space are really, really good traders. But then there are also thousands and thousands of them who aren't.
Just to clarify something, by the way, to everybody, the point of this panel was more to understand how professional traders think. Not saying that all retail traders won't make money, not saying that majority of them will lose money, but it's exactly what Josh was just pointing out, is that I've met some really good traders on Twitter. They're just really good traders. They're good at it. They know what they're doing. But the majority of people that do it are not. They're just salesmen. They're trying to sell people something. They want you to buy their course. They want you to buy that. That's what the majority of people are doing out there. Not everybody, obviously. And there definitely are some really good traders out there. I mean, I guess one part of it is
everyone starts as a retail trader, right? So
it's not necessarily
I think it's hard to get a job on a trading desk if you haven't traded before, and if you've never been if you're in that situation, then like at some point you're a retail trader, right? Like,
no, you have to be. I mean, that's, as you said, Harry, you need to get that interest first so you can actually get into the field. How are you going to get in there? If it's not something you're into, you're just not into it.
We've got a hand up there, Omar.
Huh?
Yeah.
We've got a hand up from Danny.
Oh, hand up from Dick Denny. Oh.
There are some good courses as well, I should say. When I was a young man, I did Gary's course, and it was excellent. And so there's some good stuff out there.
I really think it just depends on. It's just a matter of verifying who you're. I mean, it's all about do your own research at the end of the day. And anybody who's being too, like, number one sell-offs, people are all absolute. Don't listen to anybody that says it's never going to do this or never going to do that. That's bullshit. It can go to 100,000 tomorrow and go back down to 1,000. There's nothing near you can do. Nothing that anyone can do. It could do it. And being aware of that, of the market dynamics, or I guess is the important part in this. Jake, I put you on, but your mic's on mute, by the way.
Good evening, gentlemen. Thank you. So, really interesting conversation in terms of day trading and what have you. But if you take a sort of a step back and put aside crypto for a minute and talk about, what we were talking about in just general investment before and retail investment. A lot of VCs and a lot of people who, make big positions or take big positions or have teams of traders that work for them, independently wealthy people, will say often that the way that they've made the most money in their career, when they look back and assess the times that they've sort of discovered more wealth or earned more money, is generally where they pick a position and go long on it for a period of time. And that generally is where they've seen that. They said, they've tried to be too smart for the system and day trade their way through positions, but they've found that it has not been a successful strategy for them. Buying something, sitting on it for 5 to 6 years has turned out to be a better strategy than any number of trading or fundamentals or technical analysis that they've applied. And VCs obviously have to go a lot longer into companies in order for them to get a return, if they even get one. With that sort of in mind, how would you guys take that and apply that to the crypto area? What BTC, obviously people have been going long there, but what sort of fundamentals do you think are interesting and people should be looking at if they are trading retail or they are looking to tie up some money for a long period of time? What are some of the fundamentals that you look at to make decisions on such a move?
So do you mean like a long-term holding or in shorter-term stuff? Long-term stuff?
No, long-term stuff. So, I'm talking sort of 5 to 7 year minimum period.
By long-term, I'm assuming you mean just spot buying. We're not talking derivatives anymore, right? Not as in open long position. Yeah. Okay.
Yeah.
I mean, I think, if you're long, and obviously no financial advice. If you're looking for something if you're doing something long-term in crypto, then you're obviously going to be a buyer unless you think it's going to zero, but then why get involved? You've got unlimited downside if it goes to 100K. And my personal opinion is, that's for a start, I'm not a super long-term guy, but I think, BTC is the safest, with the still great upside. So it's easy to just be long, some BTC, be long some ETH, and then you've got beta up to wazoo at that point. And, if you want to have a little specky on something small, then you go for it. But, that's a whole different kettle of fish. That's not my, I wouldn't want to go too deep into that type of analysis.
And the reason I'm asking this question is people speculate a lot about institutional money coming into the space, crypto. What's going to bring in the big guys? What's going to bring in institutional money? Well, if everything is short term and day trading and taking these positions long or short, I wonder what is the incentive for large organizations that do this all day in blue chip stocks and companies? What is the real incentive for them to do that? If that is a typical
I think
question.
most people are hodlers, right? Most people buy and hold. I think just that the short term stuff gets a lot more exciting. So it gets talked about more.
I was going to split Jake's question to two parts, as in, Josh, why did you switch from that side of finance into the crypto world? No, firstly, the second part is to Gary. What would it take? What would you need to see for you to make that move? Or is it something that you would consider? Or, I know you told me a few of the people you know and worked with have done it. What would it need for you to move there? Josh, you can go first. What made you move?
That's a good question. I would start by saying I still trade a lot of macro stuff personally. So I've moved, in a full-time professional capacity. It's not like I don't look or trade normal markets anymore. But the fact is, if you're a trader and the most pure trading market still out there is crypto. It's got the highest, vol. It's got the biggest moves. It's the most inefficient. There's the most kind of free money lying around. So, you can grind, obviously the capital you deploy is smaller. You're not going to go and deploy $1 billion of, macro capital in crypto punting it around. But, this year's a slightly different case because it's been super volatile, but most macro managers are pretty happy if they're pumping out 15% a year. They're going to be rich. And in crypto, 15% a year is not far above just the cost of capital. So the great thing that attracted to me really was that I thought there was good returns to be made, which is still my view.
Gary, what have you heard about the space? I know you roughly know a bit about it, but what are the things you would like to see to actually consider trading Bitcoin or getting into that space? Or not even you personally, but more as a firm like yours, what would they need to see to actually consider this as a viable market for them to be exposed to?
Yeah, so I have considered it, and actually I spent about 1.5 years working. A good friend of mine in Europe is quite heavily involved in cryptocurrencies, and he asked me to spend some time, and I did spend about 1.5 years on working up a proposal, which is actually about starting up a trading desk to service institutional firms, actually. So I did look at it, and I still think that there's a niche for that, and I still have the proposal around. It's just that at the time, from my own perspective, I was setting up this hedge fund, so I just, you have to prioritize. I can't do two things, but I think I think we're moving that way. I really do. And coming back to before, we talked about the other markets. I think that the more these other markets start to perform oddly. For example, the bond market with the Fed in there so much, they just destroyed volatility, makes it very difficult. And the bond market's a huge market. So as people struggle to make money because the volatility is so low, they'll look at it. From an institutional perspective, there are some things that we're starting to see. Some hedge funds, so Renaissance Technologies, have said that they're moving into Bitcoin. You've always got to take what they say with a little bit of a grain of salt. You never know exactly what they're doing. But institutions will need a certain things. They obviously got to run it through their risk models, and it's got to come out well on their risk models. So something with really high volatility sometimes on some models is something that they either won't be able to trade or they won't be able to trade in particular size. So you have to think about it. How does it look on their risk models? So whilst it can be attractive because it's high volatility, it can also be unattractive because of the way it can look. Liquidity is obviously a big issue for them. They want to make sure that they can get in and out of positions, well at all times. And liquidity is something that, you would expect would only improve over time. But I certainly think now it's on the radar. I mean, you have one or two big hedge funds such as Renaissance, and I believe Tudor Jones as well is getting involved.
I think the PJT stuff is pretty big.
Yeah, and I think that once one or two come in, others will then will sort of look at it as well. The range of derivatives as well, the more derivatives there are, you have, futures and all the rest of it. It's only going to add to the offering and to the, and to what they see, and their ability to hedge positions. And, that's all the same, all those things as well. They need to be able to not just get in and out of big size and to think, if I get into this, can I scale it? Because if you're a multi-billion-dollar hedge fund, or you want to be a multi-billion-dollar hedge fund, you're not just looking for good trades. You're looking for good trades that you can scale. And you're also looking for good trades that you can scale, but you can also get out of if you have to, or hedge quickly if you have to. You need those outs, and you need more than one exit. If you're in a big trade, you want to have a number of different potential exits. Those things I think are happening more and more. And yeah, I mean, as I say, if I got asked sort of a year and a half ago to start looking at a trading desk to service institutional customers, it's obviously, other people are looking at it as well, and it's going on. So, I do see that. I think it's going to happen. I absolutely, from our perspective with our fund, we will consider it, and my friends in the crypto space keep telling me to look at it. But again, at the moment, I have so many other things I'm looking at. But in reality, if I'm designing trades with zero correlation to equities, I'm going to have to look at crypto at some point, because that's clearly going to come into the realm that we're looking at.
But I think it's an interesting thing, right? Also, is that Bitcoin especially, but Ethereum to a lesser degree as well. But let's really just stick with the main show. Bitcoin is where it's a challenge is an interesting thing to other institutional investors, is from the point of view, it's a concept as much as it is an asset. And institutions don't like concepts because they can't figure out what to do with a concept, right? And whilst as long as Bitcoin retains the fact that it is simultaneously an asset and a concept, and a very, from a lot of people's view, a very, what would you say, controversial potential concept, is there's just not that same level of comfort that they have with something like a stock. A stock's not a concept. It's just a way that we've decided to form a company to share risk. But it doesn't have any deeper metaphysical anything attached to it. It's just a legal structure.
And the point made about like some institutional FOMO, which people have been talking about for years and years and has borne absolutely zero fruit, is actually now is a valid concept. Mainly because, PJT is obviously super well respected within the space. He's very bullish, he's long. It doesn't matter now, but if he's got your 2% and it does a 3x, then, his peers are underperforming. So there is some like game theory concepts there. If your peers have some, then is it more risky to have some, or is it more risky not to have any?
Yeah, that's fair. I think the most thing that intrigues me about all this and about everybody wanting the institutions to get in is forgetting that if we have a lot of institutional players, I mean, I was talking to it with Josh yesterday after I had a call with you, Gary. about TA and stuff. And what he was telling me was essentially that it applies more within the crypto space because most of the traders are retail traders who use TA. As such, it becomes more self-fulfilling sort of prophecy. I don't think people understand that once institutions get into the market, it becomes a whole different playing field. It changes the dynamics of how the market that I've been trading for the last God knows how many years plays. It also changes the people on the other side of the trade. I'm not trying to beat my neighbor. I'm trying to beat $1 billion hedge fund with 20 traders sitting there who know a lot more than I do, trying to beat my trades. It doesn't really, I mean, long term, I guess it would promote the price going up by validating it, but it wouldn't make my life easier as a trader.
Yeah.
I think there's a couple points for that. Now I'm having
Josh, you cut out.
Yeah.
Yeah, I can't hear.
Whilst we lost Josh, I was just going to say though that, you know, people think, oh yeah, when the big institutional guys come in, that, you know, they're going to be there manipulating the market, and that's, you know, often a retail trader perspective, right? They think that people are going to, the big guys are going to manipulate it. But then if you look at what happened, you know, for example, yesterday evening or whatever, you know, you talked about the 1500 candle up and 1500 candle down. You know, you don't get any moves bigger than that, really, right? So you don't need the big guys to come in to have big moves. I think Josh is giving us some feedback.
Yeah.
Can you guys see me?
Yeah, mate, but go on.
Yeah, well, unless you guys finished.
Yeah.
I was going to say before was, you know, I personally like, it's a double-edged sword because it'd be great if institutions come in because there's more money, it's a bigger market, you can deploy more capital, but it's not great because returns will go down and there'll be less opportunities because there'll be more capital and more sophisticated capital looking at said opportunities. So it's a bit of a double-edged sword, that whole piece. But it's, I mean, I think it's inevitable, so it is what it is.
Well, yeah, of course, that's just, it's part of the process. I just think, yeah, as you said, I think there's a lot more opportunity while they're not feeding on the market yet. It's a lot more profitable for me personally. It's a lot better for me personally to drag it out.
Yeah. So I was in Singapore, not for Consensus the time before, so that was like June last year, and a friend of mine went up and I went up together, and we met with some really up there, one of which was a proprietary trading firm, mostly in stocks. And essentially all they do is when they go to find the newest market they're going to trade stocks in, they just find the markets with the highest retail flow. So these guys were a bunch of, you know, Singaporean guys, but they'd basically been, you know, spending all their time trading Thai stocks. So it's a SET 50, because Thailand still has 80% retail flow, 20% insto flow. Then it also has something really, really interesting as well. The exchange is really, really old technology. So any of the trading systems built that has to use the data of the exchange are really slow. All the really smart guys, like these guys, have built data capture systems to sit in front of the exchange, and they're actually a lot faster. So not only do they have 80% retail flow, they've got an actual market, you know, technology advantage. And that's what that's like, you know, that again is time and time again what institutional investors and traders are looking for. They're looking for a definable edge, which, you know, obviously Gary, you know, knows, you know, and lectures on, fucking talks about a lot. Having that knowable edge is really important.
Yeah, I think that edge you talk about is something it's very important. I mean, again, as a trader, that's your specialty, I guess. If everybody has your edge, then you don't have an advantage to profit.
And like the guys have been saying, I mean, really, you want to find the easiest game in town. And I think Grant hit the nail on the head before, where he said that a lot of institutionals have viewed all cryptocurrencies as a concept, but it won't take very long at all. It will take 1 month of one hedge fund, or one quarter of one hedge fund doing well before the others go, well, I don't care whether there's a concept or not, there's money to be made. But you want to go and find, an easy game. It's like, if I'm going to play poker and I'm in Vegas and there's 2 tables, and there's one table with a bunch of guys in their 30s wearing hoodies and, wearing Josh's earbuds and sunglasses. And then there's another table of guys in their 60s wearing Hawaiian shirts, drinking margaritas and daiquiris on the table. Which one am I going to go to play poker, right? I'm going to go to the easiest game. So absolutely,
which one would
I'm
you
going to the Hawaiian
perceive to be
shirts,
the
mate.
easy-
I'm
Okay,
going to Hawaiian shirts, mate.
Good to know.
Yeah. So it's absolutely. I think it's right. I mean, the idea of a concept, and that's in my early days, in the first couple of months that I was putting together this proposal on crypto trading desk, that was the hardest thing for me to get over, was this concept, because to me it was still a concept. And then once I got over that, it doesn't matter whether it's a concept. I'm been asked to design a trading desk to do this, so that's all I have to do, right? And that's that. But it took me 2 months, Grant. Really, seriously, 2 months to get over that idea before I said, well, okay, then if this wasn't Bitcoin, if this was convertible bonds, which is what I ended up coming back to. If this was like the convertible bond desk that I worked at and headed at, how would what would I think about it? How would I structure it? What would I want? And once I got to that point, the rest of it became quite easy to put this proposal together. So bang on that one.
Yeah, it's the whole thing. Like we that whole thing we touched on there, and before there was one thing we touched on, and it's interesting you say, Omar. It was on the point you were saying, mate, about 7 years, don't call yourself a trader. But at the end of the day, whatever you want to call yourself is what you want to call yourself. But trading, I think, as Gary rightly points out and has made the point, it's an occupation. It takes a lot of hours. Most of it's boring, and it's really hard. Like, so if you want to call yourself a trader because, as you said, which I think is a good definition, you intend or do receive some income from it. Like, so you might have a bad run. Everyone does. So you're not receiving income, but you at least intend to. You're doing it with that intention. And if that is you, like if you can sit down yourself and you're happy, you think about that definition as it applies to yourself, and you are that. Well, you are a trader then. It's just you're at a different level of your journey and how much knowledge and skill you have. But trading is definitely more like an apprenticeship. We've all of us went to university, and maybe outside of some mathematical side of the shit we talk about and do, what you do at uni is fucking pointless. Trading's an apprenticeship, and it just goes forever.
Yeah, that's very. I think my thing around more. Yeah, go.
I was going to say, like, there's no substitute for screen time and for watching the markets and for trading. If you're going to trade, you have to trade.
Yeah, I think that's kind of more the point around why I don't classify myself as a trader, because I'm aware of what a lot of my friends are, and I do know what traders actually do. They spend long hours working. What we get advertised to us, what we get to see of what trading is very different than what it's a real, very tough job. That's what it is. Most people don't make it. It's comfortable, but it's not.
When I was trading a macro portfolio, I would trade all day, and then I would trade all night till I went to bed, basically, either on my phone or on a computer. And then I would wake up 5 to 7 times during the night, every single night of the week, to trade. So, and if there was any sort of big data, I would be up in front of my computer trading it. So it's, and as I said before, you're in a perpetual state of perpetual drawdown. So managing all of that stuff is, it's pretty critical.
Yeah, I guess my point goes back to exactly what Gary told me yesterday: is don't try and simplify it. It isn't. It's a tough gig. You need to do the hours. I mean, it's not.
Yeah.
It's not click the button. It's the work before clicking that button.
But it's clicking the button as well, and being happy that you lose. I mean, it's a good thing he does all the time. You look at Juice regularly, pretty much every second or third day tweets that my bad trades and my losses are my lessons. Like that's a good way to look at it, because you're always going to have losses. But this thing never has. You're never going to get a certificate of fucking accomplishment as a trader. You're going to have you're going to have a glorious 3 months, and you make 10x your previous best year. And then you're going to have 9 months of where you fucking have lost 9 months in a row. And you should expect both of those over a long enough career.
I mean, put it like when I joined my first trading desk, I was called a trader, and the guy who hired me was a very senior guy who had run significant portfolios at Brevin, Citadel, all kinds of big firms, and his title was senior trader. So like there's a 25-year or 20-year experience gap and about $5 billion worth of P&L difference there, but like our titles were effectively the same.
Yeah, Juice on mentioning him is actually I like the way Juice trades. Is very, but it is, everyone's gonna lose. That's how it is. I mean, you need to lose some. You can't, unless you're an anomaly. There's no way in the world that you are gonna get every single trade you do right. And it's something took me a while to learn. It's what I've been saying since the first show of these, is that's where risk management comes in, because even if you lose the trade, as long as your risk is covered, then you can live to fight tomorrow. And tomorrow you'll win, you make up for it.
Yeah.
If your risk management is not there, then you cannot live to fight. If you're just chasing your long until it finally catches, or you're short, or, I mean, something that's always stuck with me, I can't remember who said it to me, but it's that markets can stay irrational longer than you can stay liquid. Yeah, it should dump, but doesn't mean it's going to today. And the point is knowing when to cut it, when to stop, when to wait, when to accept I lost, and come back in again. That's
right. Sometimes it's easy. Like sometimes you get lucky and when you're wrong, and it's a gift and it's easy to close a trade, and you do that and you're like, oh, okay, this is easy. Like, I felt uncomfortable. I didn't like this. It went through a level, or the price action looked bad, or there was some announcement. So I've taken a loss. And in that moment, then you feel good because you've been able to rationalize the loss to yourself. The hardest part for traders is when you start to lose and you can't put your finger on a rationalization as to why you're losing.
Yeah, I'll go with it absolutely. And I mean, losses are inevitable, but you have to, in my opinion, you have to be able to learn from it. If you can't learn from it, it's another reason why I can't use, for example, chart patterns. Let's say that a head and shoulders pattern forms, right? And it forms, and it's a top pattern, and I follow it completely, and I short the market when it breaks the neckline, and I lose. What happens the next time that happens? Well, in technical analysis, you just do it again. The reason why I don't like that style is because I can't learn from a loss, and in the studies that I show in my book, the head and shoulders pattern it's got a reliability of about 50%. So you're going to lose 50% of the time. And you're never going to know why. You will not be able to improve it, because if it breaks the neckline, that's it. And I just read recently, and I've put a couple of reviews on my YouTube channel for 2 Matthew Syed books. I think they're really good for traders. One of them is Bounce, and the other one's called Rebel Ideas. And I think that they're really good. He talks about the process, and he was actually an Olympic standard table tennis player. I don't know if anyone's read those books. Olympic standard table tennis player. And he talks about, he interviews people like Dyson from the vacuum cleaners and top professional sportsmen, and the processes that they go through to become at that elite level. And I think that, as I said at the start of this, that trading is like being a professional sportsman to get to that elite level. And the processes are very much about small adjustments. And too many, I think, retail traders think, oh, I'm just going to discover something one day and it's going to make a massive difference to me. Whether it's a new chart pattern, whether it's by using this RSI or Bollinger Bands or whatever it is, this is going to make a big difference. That's not how trading works. And in any elite level, it's just a combination of small adjustments. You're going to have a loss on a trade, you'll figure something small out, you adjust, you do that again. And that's what, hopefully in 3 years' time, you're better than you were 3 years ago. But it's never a huge leap, that, or very rarely going to be just a big leap. And you shouldn't expect it to be that way. Just, continual adjustments. And I think that if I wasn't able to learn from losses, I personally, I would find it terrible. If like a golfer, absolutely snap hooks a ball, if he can't correct that, then he can do that again and again and again. I think that, every professional wants to be able to learn from a mistake.
I think it's a craft. It just needs to be, you need to work on it and perfect that craft of yours. It's not, again, not a get rich quick scheme.
I mean, I would add a few things actually to this conversation. Firstly, it would be just an anecdote. So, when I was trading for props, I had a very big, very, very large loss over the course of about 30 seconds on a Fed announcement, and obviously not ideal. But, that then led to me completely revamping the entire way that I sized my portfolio and almost my entire approach to portfolio construction. If I hadn't had that loss, it would have happened eventually, I guess. But, that would, in the long run, that would have been negative. A couple of other things, if you, on the topic of like drawdowns and being and losing trades, it does depend a little bit on what exactly you're trying to do. So because in some sense, if you think you're right, then the more the trade goes against you, then the bigger asymmetry it is to have your position on, because the larger the dislocation is. So, there are some like negative gamma characteristics to thinking like that. And it's a, real problem with like relative value trades where, technically the more money you lose, the more money you should make. But, that's something to think about, how you balance that fact versus being disciplined versus having like a robust framework of what to do. And in terms of like the win-loss thing, once again, I think a lot of that comes down to your strategy. Like there are arbitrage opportunities that are out there that are close to risk-free and very rarely have losing days. But the risk in those types of strategies is like a catastrophic risk. So you will win, technically you could win well over 90% of days, but if you're wrong in crypto, your account will be zero. So, that's that kind of binary risk over your ARB is, a completely different thing that you need to monitor. And, firms got caught out on that, on the big BitMEX wick down to 3K or whatever, where, they had market neutral ARBs on, but then they weren't that market neutral because of the liquidation risk. So, like everything in trading, it's, there's a lot of different aspects to it, and it's never linear, and it's never not a simple, question of, okay, I'll put it this way, for me, like, strategies we do at least, some do, but most of them, it's not like I sit there and go, I'm going to risk 1 to make 4, and I've got to below 10K. But that's just not really how it works. That was all I had. Do you want to ask me some further questions?
The last sentence you said cut out for a bit. I didn't hear what you said at the end. You said something 4 then 10.
I said no, as in we're not necessarily sitting there being like, well, I've got $10. I'm going to risk $1 being long to make $4. I think that's all and I'm going to stop because because of whatever. This is why I'm going to stop, because I will have lost 1. There's a lot of other things that should go into that stop loss and, that risk reward decision, aside from just those factors.
Did you just say stop loss? I thought stops were for buses.
Stops are for buses. So unless you're a bus, I don't know. Stops are not there for buses. I will say, BTC especially, crypto is a very tricky market for stop losses.
You will get wicked out. It is impossible.
This is the problem, right? The problem is the stop will save you from just getting obliterated on a wick. Also, generally, the bottom of the wick is where you want to be adding some risk if you like your view. So, it's not clear, different horses, different courses or whatever. But, it's not,
But our markets the infrastructure is not even there yet. Yesterday, you had all the exchanges drop down to 9,300, 400, and then BitMEX going down to 8,600. It's like
True,
playing with
but I mean, that's also an opportunity. Like, that's not all bad. I mean, it's obviously bad if you buy on BitMEX, but I mean, like, if you have the ability to go and buy BitMEX and sell on somewhere else, like, you just yourself $500 risk free.
yeah.
Obviously, the
Unless you were long on,
move fast. Look, I mean, like, we hold collateral on most venues, most trading venues. So, I mean, I guess it's a little bit different, but there's always kind of opportunities in the madness, right?
Yeah. No, definitely. Yeah, of course. In madness, there always would be opportunities. Now, let's go to, I mean, S&P. What are you guys' thoughts? Where do you think it's headed? I mean, Bitcoin's been moving along with it a lot. Did anyone feel it's going to crash anytime soon? Are we going to keep seeing green?
On Bitcoin or Spurs?
No, S&P.
Too hard. Not sure.
Yeah.
I mean, Bitcoin's been moving with it, so...
I think a correlation to Bitcoin, I mean, I don't really even watch Spoo now for Bitcoin. I was glued to the screen, but I haven't been watching it too closely. I think that correlation's kind of rolled off a bit, personally.
It's rolled off a bit, but it's still there in the sense of green means we're going up, red means we're going down, just not as closely correlated.
I think right now it just exists on the extremes. When Spoo's plus or minus 1% or 0.5%, I think it doesn't really matter. If Spoo's limit down, I'm sure Bitcoin will sell off. Well, not sure, but it's highly likely. And if Spoo's limit up by a bit, it's probably going to rally. But I mean, the correlations in crypto just generally are super unstable. Sometimes it's correlated to $CNH, sometimes it's correlated to risk off, sometimes it's correlated to Spoo, sometimes it's not correlated to anything. Like, I think, in a macro market, the correlations are much more stable. You know that in a period of stress, they're going to, go to 1, as everyone says. There's well-established relationships. Look at dollar, you want to trade dollar yen, you can look at real yields, you look at, a bunch of other stuff, or gold, you look at real yields, etc. But in crypto, I think the correlations are very unstable, and that's kind of it is a bit of the beauty of it as well. What is in play, and is there one?
Okay. Welcome back, Grant.
Thank you, Go. Sorry.
We're just talking about the correlation between S&P and Bitcoin.
Yeah, I mean, I had a great conversation yesterday with Tom from Mind Digital about that. It was one of the things I was saying to him. I was saying how before we had the sell-off in March that I really liked the way Bitcoin traded. And when we started, we do this analysis and we started to break down why was that. Well, it got in a nice uptrend. That's cool. That's easy to trade for Bitcoin because trading from the long side of Bitcoin is normally easier. It kept doing these moves on liquidity where it would drop 3-4%, where you could get some nice fills, and then it would, sort of grind itself back up pretty good. The other thing what it was doing at that time was that correlation with equities. So every time you could see equities, if Bitcoin was sort of like lagging and doing not much and equities had sort of gone to a new high, it felt like a pretty safe trade to come in, pick up some corn, and see what would happen. But now, especially in the last 2-3 days, is that we had obviously the big rally up, which was deserved, and then now we're in this pattern at the high, and there is no correlation to equities, but you do get the feeling though that if equities did suffer another like sharp sell off here, the Bitcoin would get hit with it. But otherwise, I think if equities continue to go sideways here, Bitcoin and crypto more fulsomely just going to keep doing its own thing. So the correlation will go away even more, which is great. Because then it's proven that crypto is doing a good thing. Like, it is not just an equity replacement product. It's not high beta equities. It's an actual proper thing. The other great thing that I love is the fact we're seeing altcoins pump. Unfortunately, not the ones I own, but altcoins pump on the basis of the fact that they're actually doing something. OMG, for example, fucking rolls out and says, look, Finexa fucking hit us up. We've fucking onboarded Tether. We've fucked
George was telling me to buy that for so long, and I kept ignoring it.
Yeah. Oh, mate, but you could have bought, again, no, perfect example, that's fundamental analysis versus trading, right? Trading, you would have bought, if you bought OMG anywhere in the last 3 months, you've lost money on it. So he had to have told you to buy in the last 3 months for you to care about that advice. George is a great fundamental analyst, but he probably told you that 18 months ago, and then it fell another 75%, and now you're still offside. There's a difference between trading and fundamentals, right? Like, one is that, yes, as a trader, I use fundamental analysis to inform my decisions, but at the end of the day, I'm a trader, so my P&L actually makes most of my decisions for me.
And on the correlation point, like, and Spoo, I mean, historically, there's a reasonable correlation in some periods between $CNH and BTC, right? So, but then hypothetically, let's say $CNH goes to 8 tomorrow, and Spoo limit down. Are you buying BTC because of a dollar-China correlation, or are you selling BTC because of a SPX correlation?
Probably sell it.
You know, I mean, it's just, you know, that's horses for courses, depending on what you want to do. But, like, my point being that, you know, these correlations, where exactly crypto fits is still fragmented.
Yeah, but the biggest thing is actually, and Gary will be able to point to this more so, is the funny part is, right, is so the correlation that gets held up as the gold standard was basically, you know, was the whole Bridgewater thing was SPOOs and bonds. And Dalio and his other geniuses supposedly, you know, came up with this concept that, you know, risk parity works, and yeah, it did work beautifully for them through 2008, and then since has been an absolute unmitigated disaster. But at the end of the day, what Ray Dalio did a lot of things. But one of the main things he did was convince the investing public of a complete fucking falsehood. He convinced the investing public that the correlation between bonds and stocks, which are the two major asset classes in the world, have a steady correlation. When, again, you get a first-year stats student and ask them to do the correlation over different periods, you'll find it's anything bar fucking constant.
Yeah.
It was a great narrative and storytelling device for Ray to come up and sell the product that he wanted to do anyway, and it was just it helped them sell more of it. It wasn't. It wasn't.
Stick a bit of
deep about the market.
Stick a bit of inflation in there, and then see how it all goes.
Yeah. I mean, spot on, Grant. I mean, I think correlations in general have become a lot more complex now, particularly with the Fed active. And I say now they're buying junk bonds, for crying out loud. I mean, usually you'd say, oh, the economy is falling apart. You know, the weakest bonds, you'd be wanting to short them, or those stocks, you know, they go bankrupt, and some of them are. But now you can't short junk bonds because the Fed are buying them. So what does the junk bond ETF market tell you about what's happening in Main Street? Not a lot actually anymore, unfortunately. Bond market is much more complex. And bang on, I mean, we design zero correlation equity trades. We looked at bonds. We don't have any trades using bonds, right, in our group of trades. And we looked at those straight away. And Josh mentioned earlier that when the shit hits the fan, a lot of these correlations go towards one. Now, you've only had to be in the market for any reasonable length of time to know that. Yet, still, a lot of these quant funds and these other funds got smashed in March, got absolutely smashed. It's like, this is not a secret. This is not, like you said, any stat student will find out these things, yet they all got smashed. And from our perspective, obviously, you know, we are only sort of launching at the moment, but our trades, which have a roughly zero correlation, still had roughly zero correlation in March, and still had roughly zero correlation in April. Didn't matter whether the market went down or up. So, you know, does that mean we'll be able to raise as much money as Dalio? Of course not, because it's not that kind of a world.
No, you're not selling, you know, repackaged beta.
No, exactly. And that's more about, isn't it, about this industry. That is a part of this industry, which is the job, and it's partly true. The job of Wall Street is to basically sell its shit to retail investors. And what they do is they have all this stuff and they think, how can I repackage it and sell it on to other people? And, you know, some firms are very good at that. And I think junk bond ETFs are one version. But, the correlation thing's interesting because a lot of correlations are breaking down. We try to use them in trading quite a lot, but it's becoming more complex, particularly in the non-crypto space, right? You know, bonds, it's very hard now. The central banks are the biggest buyers of them. They're huge in there. They're distorting the market, clearly. The Japanese authorities are buying, what do they own, 70% of the stock market through ETFs? That's a different market as well now when you have someone like that playing. So a lot more complex now to watch them. So the whole game is more difficult.
And that's a whole different conversation we can talk about forever. But let's not get into the politics of governments getting involved with things they have nothing to do with, like markets.
No.
Markets should be free. That's how they're meant to operate. That is the whole assumption we operate under, is that the market is free. I mean, as you said earlier, Gary, if business is doing bad, it should go bankrupt. That's how it works.
Yeah, let's not talk about crony capitalism or fake capitalism.
Yeah, I mean,
you just want that environment, though, that if something is bad and you short it, they will go down, right? I mean, otherwise, it's kind of like, what's the point? If this company is bad, and I should be able to short it and make money, and in that sense, I'm giving a warning sign. But if the idea now is that we're going to support weak and strong companies, then that has changed the game completely. And ultimately, none of us here can fight that. You just have to accept it and incorporate that now in the way you trade.
And it's the same with trading, right? Like everyone does trades sometimes. It's impossible not to. And if you do a crappy trade, then you should probably be getting a crappy outcome, really. Like it happens.
I mean, we can whinge about, and a lot of people are whinging about, or what central banks are doing, and that's you can whinge about it, but you're not going to stop it. The question is, you just have to accept the environment you're in and trade that as best you can. That's the goal of a trader. We can't set the environment; we have to trade it. And these people that are whinging and saying, "Oh, I'm not participating in this because of that, and this is fake and this is wrong," well, then sit out then for the next 10 years if that's what's going to happen. But it's not your job as a trader.
Yeah, and again, good point, Gary. And this though becomes then an interesting segue back to, I think, it's important for some of these other listeners tonight and for people listening to the replay in future is if you then get to a point of where you don't see a trade that you want to do, or you don't want to, you're happy, you say you bought and then you exited and you bought some other stuff and you exited and all of a sudden you find yourself with 100% cash balance. Well, there's a few things there again you can sort of look at. Is one, that you were into the theme at the time and the theme's played out and you've taken your P&L off the table and it was just more a passing interest or whatever rather than it was something you want to actually do. But then the next part of it becomes, and if it's not that, if you actually are going to continue then on as trading, well, enjoy that small break because, the few times you ever get flat in life and can actually take time off is relatively small. You got to, otherwise you're pretty much always on at some degree all the time. And I think for a lot of people, that's where, one of the big, again, misconceptions they get fed is that trading is something you can go and come back to. Well, that's just not the case. If you're out of a market for 3 months and you try to come into it, it's hard to read it.
You will get carded.
Even as a retail trader, if I stop trading for a month, 2 months, if I go on holiday for 2 months, I just decide to stop trading for that 2 months.
Yeah.
I will come back and start losing for the next few months until I actually get back into, back to the athlete analogy. Yes, exactly. You're getting back. You need to train your mind again to get back into it.
Absolutely.
Not to.
And on that topic, oh no, sorry, go.
No, I was just gonna say. Yes, a lot of things are like, even emotionally, it does require a lot from you, like sticking with your plan, not changing regardless of what you hear. That's it. That's what I'm doing. That's what I'm sticking with. And I'm happy to take the consequences. That's, if I'm right, this is what I do. If I lose, this is what happens. I'm aware of this. I'm accepted it. Let the trade go. That's it.
Yeah, I know of traders who have got, like, I guess you call it quite reasonable health problems from the stress of running large positions before, and like it's like I've got health issues before from like wrist sizes and stuff, and it's just a part of the game. And on another note, coming back to something we were speaking about a bit earlier that I forgot we got into raise as well, was it's really important to know yourself as a trader. Like, everyone has their strengths and weaknesses, and unless you have some reasonable idea of what your strengths are and what your weaknesses are, then it makes it a lot harder. Like, I know, for example, I'm really good at leveraging up a trade when it looks like I'm right and I'm picking that spot to deploy all that risk. That's a strength of mine as a trader. But, I know, for example, I'm bad because, I have a habit of over trading, and to me, it's more emotionally painful not to have a position on that works than it is to have a position on that doesn't work. So, if I lose a bit of money, I don't like it. I have a little bit of a rant maybe, but it doesn't really affect me in any major way. But if I have a strong view on something, or even a view, and it works and I don't have it, getting the beers out. So, I think it's really important to know exactly where you sit and where your strengths and weaknesses are, and then you can account for it, right? So I know, well, maybe it might not look like the best idea, but, maybe it is a better idea for me to have a very small position in something, to get rid of that potential emotional angst. But then I know I'm prone to dabbling and putting on positions that I shouldn't really be in. So then how does that fit in with that? Should I really have this position on? And, it's very important that whether you document it or not, it's important to have an idea about all these things and some sort of plan of attack.
Yeah, if there's a lesson to learn for the viewers out there. It's stay away from 230 steepeners.
Stay away from swap steepeners with a bit of an exotic derivative in them.
Yeah, so if sold by a bloke called Anton Van Camp, definitely stay away.
I get itchy if I'm not in a trade. So when I'm not in a trade and I just want to be in a trade just for the sake of being in a trade, I will simultaneously open a short and a long. So no matter where it goes, I'm still at the same place. And that way I can
buy a straddle. Just buy a straddle instead and hope it moves.
I don't know what a straddle is, to be honest.
Yeah.
Buy a call and a put and close your eyes for a while.
I haven't got into that yet. That's options. I need to start learning about that.
Crypto options. Oh my goodness!
We're gonna have to do a Whisky and Wicks around crypto options because nobody crypto understands what options are and how they work. I don't know what an option is.
Gary understands this. People think options trading is free money because there's leverage and people post a screenshot. You buy 1,000 calls and you make 1,000x leverage. But the complexities of options trading is on another level compared to the complexities of a linear market trading. Our options portfolios would make you cry, not necessarily for good reasons, but it's a completely different kettle of fish. The number of times I see people posting their trades on Twitter, and we've got we're their counterparty, and you wouldn't believe it. And half of them are winning trades as well, and they look like big winners for them. But we're on the other side of it, and we're also doing just fine.
Well, yeah, I think that's I was listening to something right before this about traders and stuff, and it was a bunch of professional traders talking. And one of these things, in the professional world, if you did something like that and posted a tweet of your position, you would get laughed out of the professional community. People will be like, "What's wrong with this? Why are you doing that?"
Well, you just never.
It's either you're lying or why would you do that? Why does it matter?
Most probably lying.
Yeah, but you're also just giving yourself you're giving someone a free option on you. If I know this person has this position in size, okay, great, I have information about you that you don't have about me. So who has an advantage there?
Nobody should know your next move if they know it. Then
you have a close circle who you can talk with, but otherwise, keep your risk to yourself.
Gary was saying to me yesterday, as the market two people, predators and preys. If you're going to run around telling everybody where you are, then whether you like it or not, you're a prey because everybody can see you. It's just
the idea of posting your trades, of telling people what you're doing, is I don't understand it.
It's crazy.
I find it bizarre, and I just think people should see through that. Professionals are not going to tell you what they're doing. Not right now.
Yeah, I will tell you when I have my full size on, then I will tell you.
About to get out.
And then if I've got this position on and I want to try and get some people in behind me, then okay, cool, I'm happy to talk about it. But until that point happens, there's just no chance. Yep. In crypto, I think especially in a macro market, there's a lot of players. It's a big market. If you say you want to put on 500K a point of some interest rate swap, you can kind of put that on and the market will absorb it, and like probably no one really cares broadly, you know. But I mean, in a crypto market where it's so small and the flow impacts are so large, your flow can have a very disproportionate impact on the market pricing and thus your future P&L. So I mean, it's very important to know how to execute it and to execute it in a manner that doesn't end up shooting yourself in the foot.
I mean, in the early days, 2013, 12, like back in the early days of Bitcoin, it was a lot smaller than what it is right now. You'd be able to get into a group with 10 guys into a Discord channel and be like, okay, we know this guy is going long. Let's all just market sell. And you could physically dump the market with just 10 other guys. I mean, there was barely any volumes. It used to be you'd prank someone else. Like you'd prank someone because you knew what position is in. You just wanted to be a dick about it. You go with your friends and just market short and just dump it. I have a question. I think this one's for Gary. It's from Rob again. So if we're going to assume BTC is a concept, that's how it's taken, in many ways based on human emotion. How do you rate Fibonacci as an anchor for short or long trades?
I don't.
Or how does anybody rate? Yeah, I know you would.
Yeah. So Fibonacci, I don't. And the thing is, look, obviously, it sounds like it is a mathematical concept, so it adds some credence to it. I don't understand why or how it's applied to trading. Because the charts itself, and if you have to think about the charts themselves, have a think about the axes on the charts. Does that really fit with how markets work? Have a think about, the time scale. Why are they using time? So for me, the whole concept of the way that charts are constructed is a misleading way of, it doesn't represent how the market actually traded. So in terms of using Fibonacci, look, I understand. I do know, other technical guys use Fibonacci levels, but personally, I have never cared or looked or pay any attention to them. From time to time, a market will hit near a Fibonacci level, but a market will hit near any level at some point. So, and they have been tested. There are studies that tested Fibonacci levels on markets, and they didn't come out with any kind of positive.
Josh, do you use Fibonacci's?
I don't use Fibonacci's. No.
Grant?
Never used them.
Oh, man, I like the retracement stuff only purely because I think coming back to like what Gary was saying, like yes, a lot of these technical patterns don't have particularly great great predictive power. What I like using is the retracements just purely for my own benefit to know, especially in stocks mainly. I use them where, okay, if I think that stock is 30% overpriced, well, I think it should fall to here. And then where does that look like on a Fibonacci level or something like that? And you might be able to not get more conviction, but it'll make a sense to have that as an entry or exit point. Again, I think we touched on this earlier. Why are these patterns probably maybe working a little bit better or more prominent in crypto? The other thing is in crypto right at the moment is we just don't have a lot of market commentary around the fundamental. The fundamental story is that Bitcoin is a ever-evolving protocol that is obviously moving towards some degree today than it was yesterday of improved performance and better features. But from a fundamental point of view, if that's not changed anyone's fundamental view of Bitcoin, well, therefore we're still at the same level. So why is then Bitcoin moving? Well, I don't know, because it's got to do with flow, it's got to do with this, it's got to do with that. Well, I can throw up some technicals and get an explanation for it. It's at the end of the day, it's what humans do well. We're master narrative creators. We create narratives, and that's what we're essentially doing for ourselves. And it comes back to the point of your personality. So there's a lot of research done on this. There are people who are just born to be contrarians. They find it hard to go with the curve, with the trend. They just naturally are a contrarian person. Most of the population, they're a small amount. Most of the population, about 60, 70, 80% are pro-trend people, and they'll always just jump on the bandwagon and go with it. Then you've got the contrarians. Then you've also got a small group of people who sort of don't fit nicely into either camp. But at the end of the day, you've got to then decide if you're a contrarian. Well, probably looking at this stuff would just really make you confused and make it difficult for you to make, heads or tails of what you're trying to do. So you need to, again, always in these aspects, put these tools into, or these narrative, tools in contrast to what you're trying to achieve. If, for example, tomorrow you ring me up and go, okay, for whatever reason, you've done some voodoo overnight and you think 9,500 is the best price ever on Bitcoin, you've just bought it, 100x leverage, and you're going for moon Lambos. And in that, you might have the right position. The reason why you put it on might be completely wrong. But then at the same time, what you do need is you need some conviction to stay in it because you've put on so much leverage. So then if all of a sudden you find then that someone on crypto Twitter throws up some pattern that validates it, where you're going to go, yeah, see, this is what this is what I knew was happening. I'm validated. But really what you needed was just that little bit of extra, intestinal fortitude to stay with the position to where you thought it was going to go in the first place.
That kind of is one of my main. It's kind of one of my main critiques of TA in general. Not that I do think it works in crypto just because it's all retail traders and most of them use it. It just makes sense. That's why these levels actually hold most of the time, at least. Not yesterday they didn't, but most of the time they do. Self-fulfilling prophecy and all. But the problem with it is that I'm looking at the FUSD chart right now, and because I'm personally bullish, I can see a bullish pattern. But if I was short, I can guarantee you that if I looked at it long enough, I'd find you the short pattern, the bearish pattern. In every point, there are both patterns. So I guess I more use TA in crypto to understand the levels other people are buying in at, or the majority are buying or selling at, and just know where those key resistance supports are. I'm not a big fan of the whole draw triangle, that's where it's going to go, because I can draw another triangle, I'll go the other way. And you can't tell me I'm wrong until after it happens.
Yeah.
Yeah, exactly.
If I could just make a couple of points. Firstly, in the revamp of the book, I just found some new studies in recent years on TA, and there's a couple of interesting things. There's some really good studies showed that they found that there are some signs that some TA indicators work in immature markets. So that would, potentially be of a help in crypto, that when markets become mature and more people enter it, that basically whatever it is it's picking up fails. In terms of the idea of it being self-fulfilling, which I don't doubt can happen, and that it could well be what you see in crypto. There's so many traders use these levels that they can be some self-fulfilling nature. The interesting point about that argument, which, as I say, may be true, is that the people that initially came up with technical analysis, the people that taught it and the people that taught me, and even 30, 40 years ago, will say that 100% that is not the case. The technical analysis isn't successful, if it is successful, because it's self-fulfilling. And the reason they say that is because the reason that it's supposed to be successful is that it's a good, not predictor, but it's very good at analyzing market psychology. If the only reason why it works is because it's self-fulfilling, then that's a completely different argument to it's analyzing the psychology of the market. So that's why, and I've got a course in front of me that I've just been using in my book where, the guy actually says it's utter rubbish. He puts it in big letters to say that it's self-fulfilling. So I find that quite interesting, because I don't doubt that at times it can be a little bit self-fulfilling. So that immaturity aspect, I think, is interesting. And the last point I want to make is about that idea of justification, because I always found in investment banks particularly, so my process when I have a trade is I always think I'm wrong, right? And I'm always looking for like this, and an investment bank, particularly when I was at ING, people saw that as a weakness of me. When I first went to ING, I was on this convertible bond desk, and there was a lot of these star traders that they'd hired from all these other banks. And I'd just come off the floor, and I had this sort of process of, oh yeah, I've got this trade, I really like it, and I might have the trade on, I might have it on in size, but I'm always thinking, why could I be wrong? Asking other traders, what do you see of this? And people thought that was a really odd thing and doubted me. And then I read a book, one of George Soros's books, and he says, like, he goes through the same process when you have a trade, you need to find out reasons why you're wrong. And it turns out it's actually a very good process for you. Otherwise, you just look for confirmation, and confirmation bias is what comes in. You only listen to people that you agree with you, and you don't listen to those that you don't like. And therefore, you end up with this confirmation bias and you'll make bad decisions. So I actually, I say to people, that I think it's a good idea when you have a trade is not to look for justification why you're right, but to look for reasons why you're wrong. If you can't find them, you'll stay in the trade. But it's always good to listen to other views.
Yeah, that's an interesting thought. It's definitely a good thought process to have. So I'm going to try that.
But I'm probably one of these contrarian guys anyway, so I think I think differently.
No, definitely.
And it was definitely the thing, we, unfortunately, obviously, there are a lot of, people who are out there trying to sell courses and shit like that who have no idea of what they're doing, and will give you all that basic stuff. But I mean, at the end of the day, someone like Gary, what he's doing for you is, at the end of the day, you have to already, for him to add value to you, you have to be a trader of a certain ability or certain knowledge to start with. Essentially what he's going to start to do to help guide you and improve you is basically just do that process, but you're paying him to do it, so it's done in a much more rigorous fashion. You're going to be saying to him, look, I've got this trade on, and he's going to start questioning you. And that's what you need oftentimes, because if you've been, especially if you've been a self-trader for a long time, which a lot of people in crypto are, you've never heard a different voice in relation to your trades than the voice in your head. And that is a really, really big thing that you've got to get yourself to do. You've got to put yourself in a scenario where, other than the voice in your head, is actually wanting to discuss with you your trades and why you're doing them and what they look like.
Which is why I like certain groups, certain paid groups. I don't like the ones that I'm a lot of paid groups, and I'm not advocate or like the ones that just straight up tell me buy at this level, sell at that level. I'm more into the ones that restrict the quality of people that are within the group, to allow me to do that and get actual feedback on anything I'm actually doing, to be questioned in a high IQ way as to why are you doing this and you're wrong or you're right. Like Mining Store, for example. That's why I like it in there, because there's smart people in there that will tell you this is why you're wrong. And then you'll actually think about it. Go like, okay, wait, I could be. Yeah. But I have learned not to listen to people most of the time. That's one thing. Most of my losses have been just blatantly listening to someone else's opinion. Because at the end of the day, again, you have to live with the consequences. I'm happy to suffer the punishment for my decision, but I'm an idiot. If you tell me to do something, I do it, I lose. I have no one to blame but myself for listening to you.
Yeah, that's 100%, and that's a big thing that you have to, as a trader, take responsibility for what you do, right? And there's a lot of people that they will go on and they'll want someone else's advice, and before they'll trade or whatever. But ultimately, you must be able to take responsibility. You must take responsibility. It is 100% you every time you trade, and if I ask Josh and he says, yeah, Gary, I agree with you, buy this. But if I buy it and I lose, it's my fault. It's nothing to do with, and you have to accept that.
I mean, I think there's some value from getting opinion from people who you respect, et cetera, et cetera. Like, there's certainly value to bouncing ideas off people in your circle who you think are good. But, when push comes to shove, you're the one pressing the button.
Yeah. The thing is, it's like, I think pros, like, I know you, Josh, you know me, or whatever. We all have our circles. I think the really hard thing for some retail traders, particularly on social media, is to filter out which ones are the ones that actually know what they're doing.
Yeah, that's true.
Yeah, that's definitely the case, because a lot of them are literally just, this retail space of trading in general, whether it's Forex, crypto, stocks, any kind of CFD trading, anything you put leverage on, they're incentivized to. The incentive is there. The incentive is there for me to tell you that I know how to show you a lot of money, drive a nice car, and tell you you can be like me at 21. It's just, unfortunately, it's there, and that's kind of what messes all that up. Okay. Now, it's been a very interesting chat, gents.
Yeah.
My favorite one so far. That's I'm starting to like
Mine
you
too.
Insto guys more.
Yeah, same with me.
Yeah, you said
Yeah.
you can't. You gotta contrast it to something.
What is it?
For Gary
Can't-
saying he said it was his favourite turn. I said, well, he's got to come back now. So
No, definitely. I think we will be doing something similar with a different topic soon, because I think this is actually pretty interesting of a talk, and
I think
the knowledge you guys have accumulated over decades is not what we found.
Arrogant. It's the best thing we can do for people who want to get serious about this. You know, fuck, no one's making money here. This is legitimately a free podcast that's going on that is full of actual good wisdom and knowledge. No one's going to approach you after this to sell you a course or anything like that.
If anyone does, by the way, that's a scammer.
Exactly. Good community announcement there. Don't fucking buy their shit. If Trader Cobb after this emails you, straight to junk. But that's what this is about. You know, like, this is about building a community and a network for people to have a educational resource available that might at least help you somewhat on your journey. If you really love trading, you find it exciting, you want to do it, but you are coming into it being crypto, Twitter's your first foray into groups and understanding of it. Yeah, things like this are invaluable, and hopefully we can do more of it. So I think it's the people, everyone enjoys it. It's a great thing from our point of view. I find it really useful because it always is highlighting what people are looking at. Especially, it's really interesting when you get people on who are new to the market and you're asking them what are they concerned about. Is always an educational exercise for an experienced trader.
Well said.
Yeah, that's it. Let's wrap this up. 9 p.m.
Mate,
Okay. So thanks, guys. Again, that was
Thanks,
very awesome.
everyone.
Definitely.
Appreciate
Thank
it.
you. Thanks,
Definitely,
everyone.
we'll
Thanks
do
for
another
having
one
me
on
on.
a different topic. No worries.
Come on, guys. Thank you very much.
Thanks, guys.
Take care,
Appreciate
guys.
it. Good to
Have
be
a
on.
good one, boys.
Love you,
See
bro.
you soon. I'll see you in Sydney soon, guys.